no further ado, I actually leave the floor to Mary. Thank you very much, Mary, and the floor is yours.
Thank you, Marco. Let me share my screen and make sure that everyone can see my slides. Do you see my slides?
Yeah.
Great. So thank you again, Marco, for such a kind introduction. It was very nice of you. I also want to thank you and the organizers of this session, particularly Giovanna Michelon, for giving me this opportunity to present my paper with equity book to market ratios above 1 and macroeconomic risk. This joint work with Duran Israeli at IDC and Suhas Sridharan at Emory. And it seems to represent many things, and yet we don't fully understand it. But having said that, the perspectives from economics and theory and accounting practice generate the expectation that book to market ratio should be below 1. This is because book to market ratio above 1, from an economic standpoint, says that the cost of capital exceeds return on equity, if we were measuring everything properly. In accounting, it says if book to market is greater than 1, it says we've got overstated assets or understated liabilities. And that contradicts the well-established conservatism feature of US GAAP. So the fact that we see a book to market above 1 is a bit confusing to me. It either says a firm shouldn't exist or we're not doing the accounting right. Something is wrong here. Now, although it's plausible, certainly plausible, that some firms are in these situations, 20% of the observations in our sample over many years, aggregated over many years, have book to market greater than 1. That just suggests to me that something else is going on here that we don't quite understand. So Doran and Suhas and I started to figure out what could explain this? What could explain this incongruity? We said, well, it seems to might have something to do with the wedge between accounting and market value. There are many things that are in market value that we don't even try to put into book value of equity. So it's not about measuring recognized assets inappropriately, potentially, but it has to do with just something that's different between market values and book values. We always think about growth options, and of course, that's one reason the finance folks think of the market to book ratio the other way around as representing growth, because we don't try to represent growth in book value of equity, and yet market value includes it. And it occurred to us, when we think about book to market above 1, that's a situation of relatively low market values, relatively high book markets. And one of the things that might be able to explain that is macroeconomic risk. That's the risk that a firm's returns are more sensitive to market conditions in recessions. Now, finance has recognized that macroeconomic risk is something that exists and it has this feature, but they haven't taken it the next step to try to figure out whether that is driving book to market greater than, they don't really look at book to market greater than 1, they look at high and low book to market as is typical in finance. So there's little prior research on book to market above 1, focusing specifically on it, and including whether it reflects macroeconomic risk. And so that is what is kind of behind what we're looking at. And macroeconomic risk can explain this because the decrease in market values during recessions is unlikely to affect expectations of a firm's future cash flows on long-term assets, because on average, not every firm, some of them don't succeed, but on average, if it's risk, then they will go down. Those values will go down in recessions and come back up again when the economy expands again. So that's the story behind this and how I got interested in it. I'm not, as you know, I'm an accounting person, not a finance person, but I do capital markets research, and this is where the two come together head on, and that's important for me to understand. So that leads to the motivating question of our study, which is, do equity book to market ratios above 1 reflect macroeconomic risk? That's the big picture. That's what we like to find out. And of course, as you know, can't always answer that question. So we try to break it down into smaller pieces. And that leads us to address 2 related research questions in this paper. The first is, does book to market above 1 predict hedge returns associated with macroeconomic risk? So there's a lot of research in finance that talk about what book to market ratio is associated with, and we're trying to find out whether, as a first step, as one step. Does it predict hedge returns? And therefore, it could possibly be macroeconomic risk in recessions. We'll get to that in a minute. And the second one is on the accounting side, does book to market above one reflect potentially overstated equity book values, but not so much in recession years? So in recession years, what's going on is the macro risk, which is driving the book value, the market value of equity down. That's what's causing the high book to market ratios, not that the accounting is too high. Market value of equity is not too low. It's right in some sense. They're not saying it's mispriced or something like that. It just reflects a risk that is not reflected in the accounting. So those are the two pieces to the two steps to the research question that we're going to do. In terms of research design overview, we're borrowing a lot of structure for addressing these questions from prior research. So there's not a lot of innovation in the research design itself. It's more, I like to think where we're innovating is thinking about whether this could explain book to market greater than one, and then putting evidence together to convince you that yes, it is. We think it is. We think there's something going on here associated with macroeconomic risk. So with respect to the first step, we do 4 tests that I will share with you. One is, does book to market ratio greater than 1 predict future returns? And that's really a necessary but not sufficient condition for book to market greater than 1 to reflect risk, because if it's a relation with future returns, you start asking yourself, could be risk. There could be returns there to this situation, circumstance, book to market greater than 1, that is compensation for investors in bearing the risk that represents. So that's step 1. If we find that, the next question is, are these returns larger in recession years? Because if the idea is that there's this macroeconomic risk, and we know from finance that risk is time varying, so it's not necessarily a firm characteristics that carries through time. It's time varying, and macro risk is something that is more pronounced in recession years. And if that's the case, then we would expect any future returns that we predict in part A, 1A, should be larger in recession years. That's to tie it to the macro notion. The next thing we do is we look at whether the fameux French factor HML, which is based on the full distribution of book to market ratios. We know it predicts returns. There's a lot of finance literature that has this as one of the main factors. But we ask the question whether it predicts returns for book to market greater than 1. In finance, again, they have high and low book to market, but they don't look at cutoffs at any particular book to market. It's just relatively high, relatively low. And if HML doesn't predict returns for book to market greater than 1, and it does predict returns for book to market less than 1, that starts saying that this is it, to the extent HML represents risk, which of course we don't know. That suggests that book to market greater than 1 observations are facing different risk from book to market less than 1. The 4th step is the age-old question: are the returns we see, is it risk or is it mispricing? And notice I say more likely risk than mispricing. I don't think we can ever really figure it out, but we borrow from prior literature approaches to figure out whether it's more likely to be risk than mispricing. That's step 1. Step 2 looks over at the accounting side and says, okay, if it's macro risk, we would expect book to market greater than 1 to be positively associated. Book to market greater than 1 could be associated with recognized goodwill and other intangible assets, unrecognized operating leases and pension obligations. But we would expect that relation to be much weaker in recession years. It may have it overall, it may not, and it may only be that high book to market less than 1 is associated with overstated assets and understated liabilities. But even if book to market greater than 1 is positively associated, then we expect the relation to be weaker in recession years. We look at these 4 items: recognized goodwill and other other intangible assets, recognized intangible assets, unrecognized operating lease and pension obligations, because those items pertain to all firms in all industries, and they're constant throughout our sample period. So those are, and also, frankly, the accountants are mostly focused with questions of whether recognized goodwill and other intangible assets have been adequately written down to their value when they're impaired, and use book to market greater than 1 as an indicator that such impairment might be necessary. And they're focused particularly on goodwill and other intangible assets. But we try to figure out which accounting items were, again, pertain to all of all firms potentially, and across the entire sample period, so that we could have things we could focus on. Now, if we find the answers to 1, A, B, C, and D are yes, no, and yes. So yes, it predicts returns. Yes, the returns are larger in recession years. HML does not predict returns for book to market greater than 1, and it's more likely risk. If we find that together with book to market may or may not be positively associated with overstated assets or understated liabilities for all years, but if its relation is weaker in recession years, now we put those things together and think that package of results should lead you to think that macroeconomic risk is being reflected in book to market greater than 1. Not saying it's the only thing that book to market greater than 1 represents, but that this is what's causing this seemingly disconnect between, hold on a second, this shouldn't happen, or could happen in a few cases, to being very widespread.
Okay. We don't have any question from the chat at the moment, so I think
okay,
you can go on. Yeah.
Okay. Let me know.
Yeah.
As I said, when I go through the results, I'll explain the design for each piece, because we don't innovate there. We just take from prior research. So I'll go straight to the sample and the data. We have almost 126,000 annual observations, where this is a year annual analysis from 9,000 US firms from 1962 to 2017. So quite a long sample period. And we do that because we're interested in looking to see whether things are different in recessionary periods and non-recessionary periods. So we need a long sample period to get variation in the economic conditions over time. These are public listed companies, of course. That's, we have market value of equities. So New York Stock Exchange, American Stock Exchange, and NASDAQ. Data from usual sources. We follow Fama, French, and Davis et al. As best we can. So in the way we define book to market, they have their own way of doing it. You know, they do it at the end of June every year. And those of you who are familiar with that literature, it's very stylized. We follow exactly what they do. We do check whether our results matter, whether we do it typically accountant way, which is to have book value and equity both at the fiscal year end, to see whether that changes anything, and it doesn't change any of our inferences. So we try to stick closely to the Fama French approach. We eliminate financial firms, just because their relations are quite different from other firms. We eliminate observations with negative book value of equity, which is only 22.4% of the observations. Non-positive revenue, because we use revenue as a deflator and for the accounting analysis. We don't want to deflate by assets. We don't want to deflate by book value of equity. These are all things we're studying in this paper. So revenue seemed to be a size variable that we could use. And we also eliminate firms that have fewer than 24 months of prior returns. That's pretty standard in finance as well. One of the tricky bits that we have to deal with is figuring out when we have a recession year. Now, the National Bureau of Economic Research identifies a recession from the peak of the expansion, the month. They just say the month, not the day of the month. There is no, you can't nail it down that precisely. So from the month of the peak of the expansion, which is when the recession begins, to the trough, the month of the trough of the contraction, when it ends. So they identify recession periods. And we have to map these periods into years ending December 31st to map it into our return tests. So what we do is we identify a year as a recession year if December 31st is more than 2 months after an NBR expansion peak or within 2 months of the trough. So for example, NBR identifies a recession from December 1969 to November 1970. We don't classify 69 as a recession year because December 31st, 1969 is at most 1 month, may even be a week because we don't know what day particularly. At most 1 month after the recession begins, which makes it unlikely market value of equity at that date reflects substantial recession effects. We do classify 1970 as a recession year because December 31st, 1970 is less than 2 months after the recession ends. That's our rule, which makes it likely that market value of equity at that date still reflects substantial recession effects. Sorry. So it's obviously this is not tight. We can't do it much tighter, but I'll show you a picture that says I think we've kept pretty much. We think we've got something here that is externally valid. Based on this approach, we identify 8 recession years: 1970, 73, 74, 81, 82, 90, 2001, and 2008 in our sample period. So those are the 8 years we refer to as recession years. Before we begin, I did talk about the results. I want to show you what book to market greater than 1 and less than 1 look like in the sample. We were surprised at some of this, but I think it's important to understand how many times we observe this, where we observe it, so that you can interpret the results that are coming forward when we get to the returns. And again, some of this was a surprise to me, but I find it interesting, which is why I'm sharing it with you. Table 1 shows the number of observations by book to market decile. So this is the first column is a typical, take book to market across the entire sample and put it in deciles. There's 12,600 per decile. And then we split it book to market greater than 1, less than 1, and book to market greater than 1. So for book to market less than 1, because of this variation over time in recessions and non-recessions, as it turns out, we didn't know this ex ante, there's book to market less than 1 in every decile of the full sample, including the top decile. Now, very few, as you see, when you get into deciles 7, 8, 9, and certainly 10, there are many fewer, but it's this split between book to market greater than 1 and less than 1 is not like taking deciles 1 to 5 and 6 to 10. That's not the way it works. Book to market greater than 1, it shows the reverse, that most of them are in the top decile. That's where, I think intuition says they're going to be in the top few deciles. And there's certainly more of them there. But there are book to market greater than 1 in every decile except decile 1. So there are some years in which the percentage of book to market greater than 1 is virtually the top 90% of firms. This is important because when we look to see whether they have hedge strategies with book to market greater than 1 and less than 1, you need to know that there is variation in the returns or in the observations in those deciles. This figure tries to present how the book to market greater than 1 maps into recession years, the recession years that we've identified. This is kind of our test to see whether our external validity check to see whether our identification as recession years and our link between recession and book to market greater than 1 makes any sense whatsoever. So the years across the bottom, the red dotted lines with the years identified, those are the 8 recession years that I talked about. And what we're graphing here is the percentage of book to market greater than 1, the percentage of firms that have book to market greater than 1. So what you see is the low point is 1968, which corresponds to the peak of the expansion that began in 1961. Remember, this is book to market. This is the economy is going up, which means book to market is going down. It's flipped around. So that's the peak of the expansion. That's the lowest book to market ratios, the lowest percentage of book to market ratios in 1968. Not a recession years. There's no red lines through there. The highest one is 1974. And that occurred, that's when it was a trough of the recession that began in 1973. So if you look more generally across the graph, our 8 recession years pretty much are when book to market greater than 1 spikes. Again, it's not perfect because we're trying to map in these recession periods into calendar years, but it looks like we've captured spikes in book to market greater than 1. Generally, it happens in recession years. The next question that we wondered about was whether is book to market greater than 1 an industry specific phenomenon? And the answer seems to be no. These are 14 industries. There are different industry classifications you can use. Use one of these from prior paper of mine with Wayne Lansman and Bill Beaver. And what you see here is that the yellow is recession periods. Again, this is now across the x-axis is the percentage of book to market greater than 1. In every industry, book to market greater than 1 occurs more in recession years, that's the yellow, than in non-recession years in the black. In non-recession years, book to market greater than 1 is at least 20% in every industry, except these 4: chemicals, instruments, computers, pharmaceuticals. And these are the industries where you would say there are a lot of unrecognized intangible assets, right? So book value of equity for these firms should be relatively small. So it's kind of not surprising that they're at the bottom of this list with the smallest book to market ratios. But except for those 4, again, 20% of the firm, at least 20% of the firms in every industry, it varies a little bit across industries, have book to market greater than 1. And some industries, a lot more. And again, in recessions, more even yet. So it doesn't seem to us that this is an industry specific phenomena. This is why we try to pick, as I said, when we go to the accounting bit, try to pick accounting items that pertain to firms across industries. These are some of the numbers. These are the descriptive statistics on book to market greater than 1, just to give you kind of confirm some of the things we just looked at. And we do it just about everything in the paper. We do 3 ways: the full sample, observations with book to market less than 1, observations with book to market greater than 1. In the full sample, the average book to market ratio is 0.85, on average less than 1 as we expect. And as I said earlier, 27% of the firms of the observations have book to market greater than 1. By construction, we split these, right? Book to market less than 1 and greater than 1. But for firms that have book to market less than 1, the average is basically 0.5, 0.49. For book to market greater than 1, it isn't just 1.02 or 1.1, it's 1.84. So some of these firms have very high book to market ratios. When we go to recession years, the mean for the full sample goes up to 1.3. And the percentage of firms that have observations that have book to market greater than 1 is 40.46% on average. And I think you saw that with the graph, even though there were spikes in book to market greater than 1. Some of the spikes were lower than other spikes. But across the 2 groups, book to market less than 1 is 0.49 in all years, 0.53 in recessions. So it is up above it. It has gone up. Book to market greater than 1 is 1.84 to 2.2. And they're 40, as I said, 46% of the observations. In non-recession years, of course, it goes, not of course, but consistent with what I showed you earlier, it goes the opposite direction. So book to market is less than 1, less and less than full sample, as you would expect, because it's the 85, the 0.85 on the first line is an average of these 1.3 and something much less than 1. 24%. So in non-recession years, 24% of the observations. Again, this is consistent with the industry graph I showed you. 20%, a little bit higher than 20% seems to be the norm. And both are lower in both average book to market ratios are lower for book to market less than 1, book to market greater than 1 in non-recession years. So again, these numbers map into the graphs that I just showed you. All right, one more bit of descriptives, which I found. Well, I don't know if you're. I enjoy doing this because this is something. When I began this project, I did not understand what was going on, and it's a discovery for me, and which I really enjoy. So this figure I find quite interesting as well. This figure shows the evolution of the two components of book to market, namely book value of equity and market value of equity. Book value of equity is in the green, and the market value of equity is in the red, or whatever color that happens to be, like a red. So this is all years. So I'm going to show you all years, recession years and non-recession years, which is another thing we do throughout the paper. The first graph is book to market less than 1 that I'm showing you here. And so book to market less than 1 all years, both book value equity and market value equity generally increase somewhat over time. So this is from T minus 1, T plus 1, and T plus 2 relative to when we measure book to market for purposes of these graphs. And when we construct the graphs, we do year T is every 3 years. So we're kind of non-overlapping in the subsequent period. So when book to market is less than 1 in year T, we're showing you what happened the year prior and then 2 years subsequent. So for this first graph, they're both generally increasing over time. Book value of equity is increasing somewhat more than market value. A year after year T, market value dips for some reason. Don't know. I don't know why any of this happens, but that's what we see. For book to market greater than 1, the pattern is quite different. For book to market greater than 1, for all years now, book value of equity is basically flat, but market value of equity decreases before book to market greater than 1, and then increases afterwards. And more surprising to me is when we look at recession years and non-recession years, you can see that the all-year graph is really an average of those other two, as you would expect. But in recession years, this decrease in our market value of equity and before book to market greater than 1 is measured, and increase afterwards is much more dramatic in recession years than it is in non-recession years. But this is consistent with sort of a temporary decrease in market value of equity because of recessions, which is the story. Again, we haven't mapped it that way yet. And then this is the book to market less than 1 in recession years and non-recession years. And those two graphs I just added look a lot like the all-year graph, except that in the recession years, the market value dips the year after. Interestingly, the year after we measure book to market, but more so in a little bit more so in recession years, but not most of the differences on the left-hand side are not significant. But you see quite a different picture between book to market greater than 1 and book to market less than 1.
Okay. We have a question from Mark Clatworthy. So Mark, if you want to unmute yourself and ask the question.
Thank you. Thanks. Hi, Mary. Just a quick question. I put this in a few slides ago, but I wondered whether you considered keeping some of the firms with negative equity in the sample. I know what you do is consistent with prior research, which is helpful, but it seems as though there might be some information in those firms, given the arguments you have. Did you consider leaving them in at all?
Actually, no, but that's a good, that's a good idea. That's not a bad idea. We should check that. We should definitely check it. Again, we try really hard when we borrow designs to do exactly what everybody else does. So but in this particular case, that would be good. There's only, as I said, there's only 2.4% of the observations.
Yes.
So my conjecture is, but I don't want to conjecture. We should do that. I think that's a good idea.
Thank you. And if I may, I'll take advantage of me having the microphone, if you don't mind. I just wondered about the measurement of book value, because you say that you use a couple of different approaches. If the if the primary way isn't available, one of the ways you use is just to take the difference between AT and LT on CompuStat, I think. Is that right?
One of the ways that we do it.
Yeah. So the standard way. So you've got the main ways that you take stockholders' equity and then you add deferred taxes back.
The way we've done it, we follow the finance literature, which is in it's a kind of a long footnote here as to how we do this.
That's the one. Yeah,
that's the one. Yeah.
Yeah. I just wonder whether you notice any difference in the, so given that so for instance, the reason I'm asking this is because I've seen the way the finance people do it. I never really know exactly why they do what they do with deferred taxes. And I really like the way of just taking AT minus LT. It's a very simple way. It's where most of the coverage is on CompuStat. But I'm sorry if I'm missing something. I was always very curious about what why they're doing that with the deferred taxes.
So I haven't focused on deferred. I take your point, and we didn't try different definitions of book value of equity. We did different dates,
right? Because
the finance people also don't. We worry a lot in accounting about matching up the date of the book value of equity is measured and market value, and sometimes deliberately we make it 3 months later or something like that. But we start with the premise that our preference would be to have things measured at the same date, and then if we move it we move the market value sometimes, make sure all the information is out, whatever. The finance people look at it differently, and they're trying to get clean cutoffs for years because they use the same, they're predicting returns. And so they're trying to figure out what information is out there before they start looking at, when they call it subsequent returns, it really is subsequent to all the information they have. Sure. And so they have this technique for trying to deal with the difference in fiscal year ends. So we follow because we are predicting returns. So we did that, but we, as accountants, we were curious what would happen if we just use it as of the end of the fiscal year, for example. And it's not very little changes, if anything. I mean, none of the inferences change. I mean, every numbers change, but we hadn't thought about different ways to measure. And you're concerned about deferred taxes, is that?
Well, I was just wondering, what the logic behind it was really. It just seems like, I mean, if we, I don't know.
Why they added to equity. Yeah.
Yeah.
Yeah. I don't know.
Yeah. Thanks.
Good suggestions. Thank you, Mark. Appreciate it very much.
Thanks.
Okay. I don't see any other question in the chat, but I want to ask one myself. So I take the advantage of being the chair. And so you focus on, as far as I understand, on economic recession and on recession in terms of the behavior of the GDP, if that is correct. Okay. Yeah. Have you thought about thinking about looking also at financial crisis? Because the little work that I have done on similar themes, financial crises do not necessarily coincide in time with with economic recessions. And given that we are looking at market value and equity and at the market value of equity, maybe another interesting thing is to see if also something can be learned about the relationship between actually financial crises that not necessarily have the same timing as economic crisis and as recessions.
That's actually a very interesting thought. No, the answer, of course, the short answer is no. We hadn't thought about it. But just a way of background for anybody interested, we came to this idea of macro risk sitting at a conference. And Suhas and I were both attending a conference, and Ken Singleton was doing a presentation about the macroeconomy. And right in the middle of the conference, I sent a text to Suhas, which across the room, and I said, "Hold on a second, maybe this is what's going on." So we latched onto this, and that's found the finance literature and all the rest of the stuff behind it. So we haven't gone down the financial crisis path. But would you expect the same idea, or
even more pronounced, because what I would expect to see something similar, okay, but given that you are looking at the market value of equity, well, that the fluctuation of the market value of equity could be even more pronounced, or you may have more actually historical events, because not all financial crises end up generating necessarily a recession, okay, and so just
that's a really good idea.
Yeah.
The takeaway presumably would be quite similar, though.
I would guess so. Yes.
Yeah. I mean, if the results hold up, I mean, it might be very interesting to see. That's a great suggestion, Marco. Thank you.
You're welcome. I don't see any other questions, so we can go on. Yeah.
Okay. All right. So that's all by way of setting the stage. And I have a lot of results that I haven't put on slides. So if we'll come to some of those later on. If you want to see them, I can have slides I can put up. But anyways, so with respect to the first part A of the first question, does book to market greater than 1 predict returns? And the answer is yes. So this is a standard decile, and we've given you the full sample. Here, the return is the difference between the first and the 10th decile. Return is 1.01 for the full sample. Significant T statistic, that's completely consistent. There's nothing surprising here from prior research in the first set of columns. The second set of columns is book to market less than 1. So the observations that I showed you a minute ago, and said, okay, and that's now you can see why there are these are deciles of book to market less than 1. So we took those uneven deciles. This is not, how can I say this? We're not taking the book to market less than 1 that appear in each of these full sample deciles. We're just taking the book to market less than 1 observations and putting them in deciles. That's why we have observations of book to market greater than 1 for the first decile, for example. We took all the book to market greater than 1s, put them in deciles. So it's not, I hope that's clear. So book to market less than 1, yeah, it predicts returns. The return is 0.40. T statistic says it's significant. Book to market greater than 1, yep, it does too. Bigger. The 0.8 is significantly larger. It's not shown here on the table, but in the paper we report the 0.8 is significantly larger than the 0.40. So it's not that we just have the top half of the distribution somehow, and it's the same distribution. We get the same return. It's the book to market greater than 1 is a big piece of what's going on in the first column. So this is step 1. So that's now the next step that we do. 1B is we say, okay, are these returns larger in recession years? Because that's how we're trying to tie everything back. Not Marco's comment notwithstanding, going back to recession years. So we want to see whether these returns are concentrated in recession years. So panel A is recession years, panel B is non-recession years. You get used to this. So the the first column of the full sample says full sample in recession years. Yep, you predict returns 1.81. So returns in general are larger for in recession years for the full sample, but it's coming from the book to market greater than ones. Book to market less than ones, insignificant. Book to market greater than one, now instead of 0.8 for the full sample, for the all years, for recession years, it's 1.46%. So book to market greater than one is where the returns are coming from in recessions, or the book to market return is coming from more concentrated in recession years. In contrast, if you look at the non-recession years, what you see is the return, overall return is smaller, not much smaller, 0.88, 101, remember, in the for all years, but it's much smaller than the recession year return. The returns for book to market less than one and book to market greater than one, it's true, they're both significant, and the 0.6 is larger than the 0.43, but they're not significantly different. So we can't statistically distinguish between book to market returns that are greater than one and less than one in non-recession years, but there's a big difference in recession years. We're starting to put together a pattern. So this taken together, this table suggests that it's certainly consistent with these returns being concentrated in recession years, which starts supporting our inference that it reflects macro risk. We're not there yet, but that's where we're headed. Part C is, this is about HML. Does HML, Fama French HML, predict returns for book to market greater than one? Okay, so this is a 6-factor model. This is from Fama French 2015. So it adds HML, the market effect, small minus the size effect, small minus big. Two more factors are in here that they've added in 2015. One is CMA, which is what they call investment, and RMW, which they call profitability. We just tried to pick something, you know, as you all know, this literature evolves, and it seems every year there's another factor. And we're happy to put in other factors, but anyways, these are the most recent ones that seem to be getting a lot of traction. And then UMB, of course, is a Carhart momentum factor. Okay, so the first set of columns. Okay, well, focus. Full stop here. So what we're doing here is I'm presenting results are for HML, which is the Fama French factor, and then we construct another factor. We constructed just like Fama French constructs HML, but we only base it on the book to market greater than one observations. And this helps us ask the question, does a different risk factor explain book to market greater than one than the Fama French factor, which is based on the full distribution? Okay, that's the exercise that we're doing here. So the first set of columns, and again, full sample, book to market less than one, book to market greater than one samples. 3 columns for each analysis. So in the first set of columns, say HML significantly associated with future hedge returns for the full sample. That's good. That's what Fama French finds. That's step one. Book to market less than one. Yep. That coefficient is significant as well, the 0.084. So HML explains future hedge returns for book to market less than one. But it does not explain, in the third column, it does not explain book to market greater than one hedge returns. 0.21, insignificant. So now we say, okay, well, what about our new factor? What does that look like? Well, interestingly, HML greater than one, we call it, explains returns in all 3. And in some sense, it's not surprising. HML and HML greater than one are 45% correlated. So they're not orthogonal by any means. And I think that's what you're seeing here. And if you look at the R squares, which I don't have in red, but the R squares, there's 60 and 69 here. There's nothing here. The incremental R square here is nothing, or the R square is nothing, just an R square. But they go from 60 to 69 to 55, 59. So the HML greater than 1 is not explaining as much of the hedge returns for book to market less than 1 and the full sample, but it still is significant. When we put them together, we find that both factors explain returns, hedge returns for the full sample and book to market less than 1. So this HML greater than 1 is picking up something that is not picked up by HML. And that something only explains returns for book to market greater than 1, not book to market less than 1. Because in the last column, the HML coefficient is insignificant. So HML does not explain returns, future hedge returns for book to market greater than 1. So to the extent that these HML factors reflect risk, which of course, as I said, we don't really know, but to the extent they reflect risk, this would say, these results would say that the book to market greater than 1 and book to market less than 1 reflect different types of risk. But they certainly call into question using the HML factor based on the full distribution in reflecting risk for book to market greater than 1. It's not significant. Oops. Now, we also, I have the table if anybody wants to see it, but we also create a book to market less than 1 factor, just because we don't want to bias it and say, okay, we created one that sort of fits book to market greater than 1. What happens if you construct another factor that fits, if you will, book to market less than 1, and repeat this exercise? And the inferences are the same, that it's HML does not, HML and book to market and HML less than 1 don't explain book to market greater than 1 returns. Only the HML greater than 1 does. Okay, now the last thing here is fine. Okay, let's say we're all convinced. I'm not sure you are, but let's say you're all convinced that the predict future returns or suggests there could be a risk, risk here. The HML, it doesn't work, so it's a different, but it does work for book to market less than 1. So if there's a risk, it's a different kind of risk. The returns are in recessionary periods, so that starts linking to macro risk. But of course, it's possible that, as I said several times already, the predictable subsequent returns reflect mispricing. So to address this concern, we use the Olson and Belinsky 2005 approach. We implement that to see whether the findings from that approach are more likely to be consistent with risk or more likely consistent with mispricing. And I don't know those of you, if any, who's familiar with that, but basically what this does, it takes the left-hand side variable is called XRET, but XRET is either HRET or LRET. So X is just an X, but HRET is extreme high returns. Those are returns greater than 50% positive. LRET is extreme negative returns. So returns smaller than, less than, minus 50%. So the idea with underlying Olson-Belinsky is that if you take something, whatever it is you think is predicting returns, if it predicts extreme positive and extreme negative returns in the same direction, so it does both extremes in the same direction, either they're positively associated with both or negatively associated with both, that says that suggests risk. If it only predicts positive returns, or it only predicts negative returns, or one is significant and the other is insignificant, they interpret that as more likely to be reflective of mispricing. So what we see here is that for the full sample and for book to market less than 1, it looks more like mispricing, because for the full sample, they're positive, but it's positive plus and positive minus. That's not risk, right? We want the same signs. And for book to market less than 1 is insignificant for high returns. It only predicts low. Again, that's not consistent in their world with risk. Whereas for book to market greater than 1, they're both positive and they're both significant, which makes it more likely that book to market, the returns are you see from book to market greater than 1 are risk. Okay, so to summarize this part, step 1, these are the questions from the earlier slide. So does the book to market greater than 1 predict future returns? Yes. Are they larger in recession years? Yes. Does HML predict returns for book to market greater than 1? No, but a factor we construct based on book to market greater than 1 does. And are returns more likely risks than risk pricing? Yes, according to Olson and Belinsky. And we have some sensitivity checks coming up. So taken together, the evidence from this first step is consistent with book to market greater than 1 reflecting that macroeconomic risk. Again, not the only thing it reflects, but just trying to square this circle between why we see so many book to market greater than 1s. What could be going on here?
Okay, there are no questions, so we can continue. Yeah.
No questions. Oh boy, we're going to be done early here. Okay. So the next step then, of course, is to look at the overstated equity book value part of this. Is book to market greater than 1 positive associated with these recognized goodwill and recognized other intangibles and unrecognized lease and pension obligations, and is the relation weaker in recession years? Okay, so to address this, we create an indicator variable, book to market greater than 1, which is just a 0, 1, if it's book to market greater than 1, yes or no. And then we take book value of equity and split it into its pieces. What we have is goodwill, intangibles, no goodwill, which is the other recognized intangibles. Pension is taken from the financial statement footnotes. This is projected benefit obligation minus the fair value of plan assets. Negative pension means an overfunded plan. This is based on prior research that shows that pension obligations that are disclosed in the notes are in fact reflected in share prices, even though they're not part of book value of equity. So that's an unrecognized item that investors seem to treat as a liability. Operating leases, we look at the financial statement footnotes and capitalize the future minimum lease payments under operating leases using an 8% discount rate. So we capitalize that. It's kind of a standard way to look at that. Prior research has shown if you're doing that, it looks like investors think about operating lease obligations as a liability. And for both pension and leases, there's research that also says they associate them with risk, leverage, and so risk of the firm. Both of these, the standard setters have done away with. The operating lease happened after our sample period. Pensions a little bit towards the end of our sample period. So toward the end of our sample period, pension is 0, but that's what we have. So what we find here, again, and I told you why we picked these items. Okay, that's great. The 2 gammas are firm and year fixed effects, and we double cluster standard errors by year and firm, as is pretty standard. There are, I didn't put up all the rest of the variables are just the rest of the components of book value equity. So it's cash and cash equivalents, accounts receivable, inventory, property, plant, equipment, other assets, and liabilities. And then the 2 firm and two fixed effect types. That's what the rest of the equation is. And they didn't present the, paper has all the coefficients, but I didn't put them on the slide here. So what do we find? whether we consider goodwill and intangibles separately. So we did one at a time just to see what was going on. They're significantly associated with book to market greater than 1. Pension operating leases and pensions, not so much. So this is what one reason the standard setters look at book to market greater than 1, say, maybe you've got on a goodwill or other intangible that needs impairment. It's an indicator of impairment, not dispositive, but it's an indicator. And when we put them all 4 together, we find the same thing. So it's still significant. So it is true that these things are associated with book to market greater than 1. But for our purposes, what matters is whether this is, in some sense, this is comforting. It says that the standard setters aren't off in never, never land by using this as an indicator, which some of us have to take personal responsibility for, but that's in some sense it's comforting. But what really matters to us in terms of this paper is what happens in recession versus non-recession years. And so 2B is the relation weaker in recession years? And the answer you will see is yes. So it's the same equation. Panel A is recession years, panel B non-recession years. In recession years, goodwill and intangibles, recognized intangibles other than goodwill are both significantly associated with book to market greater than 1 when considered separately, but not when you put them together. So this relation is weaker than the relation I just showed you in recession years. When we look at non-recession years, it looks very similar to the full years. And of course, the coefficients are larger, not just significant, but the coefficients are larger, much larger in non-recession years than in recession years. So even though book to market greater than 1 does point to it in non-recession years, it doesn't in recession years. And that says something different about these recession years and something different about book to market greater than 1 that have to do with recessions. So with respect to these 2 questions, book to market greater than 1 is positively associated with these items, but it's weaker in recession years, as we would suspect. It's just the association just is not there in recession years. Any questions, Marco, or should I go on?
No, I have one. Okay, so
okay.
At least I'll ask mine. I see the result. Okay, for this second set of, I still have a little bit of difficulties in understanding this more than the first one. Okay, so why would be the relationship be weaker in recession here? Okay, I see it, but I still don't make a lot of sense on why that should be. Okay, because are you telling me that? So what? In a way, I would expect it even to be stronger. In recession year, you may be resisting impairing your goodwill and your intangible asset. Okay, and that should, in a way, making the probability of having a book to market greater than 1 even bigger. So I still don't see the explanation of the results of the weaker relationship of book to market 1 and goodwill and the other intangibles being non-existent in recession year.
So I think the story we have is, remember, going back to the very beginning, we're trying to drive a wedge between the accounting rules, what accounting is trying to do, and what's happening with market value of equity.
Yeah.
And say, because when we look at them together, we're saying if one's telling us something about the other, it would be telling us book to market greater than 1 is overstated assets. Let's say.
That's the
right?
easy explanation. Yes.
But if there's something driving a wedge between the two, something that affects market value, that doesn't affect book value, that you would expect the relation to be weaker. So that's where the weaker comes from. And the question is, now this depends on whether you buy what we're talking about, right? Is that the wedge we're seeing, or we're talking about here, is macro risk is something that it's a risk of the firm. I'm going to show you later that these firms don't disappear. So even though there's no trading strategy here, you don't know when the recession is going to end. There's a lot of uncertainty, but on average, I showed you that U shape, right? So if you have a long-term asset and you're sitting at the company and you're trying to predict future cash flows from that asset, you're not going to take an impairment just because the market value is, I'm going to say, temporarily depressed. And we always think it's temporary, it's always coming back. Right? And that's
exactly.
So that's a hope, right?
Yeah,
that's a hope,
exactly.
but it's uncertain. That's where the risk is. So the idea is that the market value, in some sense, is temporarily depressed, temporary in the term in connection in the context of a long-term asset. Right? If you've got goodwill, we used to amortize it over 40 years. We'll forget that. But I mean, even if it's 10 years or 5 years or something, most of these recessions don't last that long. And therefore, when you, the company, project out cash flows, say, is this asset impaired, or is it just as a temporary dip in the market value? And it may be impaired a little bit, right? The next cash flows over the next year, but I'm going to more than make up for it in years 6, 7, and 8, whatever. So I think that's where this is coming from. Is we look at this as a bit of a disconnect between realizing a long-term asset or pensions, lease obligate, long-term liabilities, right? Nothing is changing in terms of from where the accountant is sitting. It's just that there's a recession which is driving the market values of equity down. It's just like when we have, think of the tech bubble.
Yeah, but
it's the opposite, right? The market value went up, and we don't write up assets, but we don't do that anyways. But
if I follow again what you're saying, okay, so
yeah,
company resist doing the impairment because they believe that the change in cash flow is temporary, okay, but the market value goes down. So this should automatically increase the book to market. That's right. And so this increases the probability of having a book to market greater than 1 going up, but it doesn't correlate with, and so this relationship should be weaker in recession year than in I was still thinking that it would still probably be more likely to see this phenomenon for companies that have more intangibles relatively to those that are less. Okay, so that's the reason why I was expecting the relationship to hold anyway. Okay, but now I see more the line of thought. Yeah. Okay. No, I'm happy.
You good? Oh, good. I'm glad. Because if our story, thank you. That's I'm glad.
Yeah, there is now Araceli that wants to ask a question. So Araceli, if you want to unmute yourself and ask.
Okay, thank you, Marco. Thank you, Mary. I just wanted to ask you, I know you didn't consider banks in your sample because they have a different relation between book and market, but I was thinking about the potential extrapolation of your findings to the banking system, because the change in the accounting standard related to impairments, for example, was taken in a recession period. So one of the indicators that there was something wrong, potentially wrong with the impairment model in banks was that the book-to-market was, that there was overstating, they were overstating the assets because of this relation between book and market value. However, according to your findings in the non-financial sector, it was during the recession that they took this decision. So maybe it wasn't so entirely true, or maybe the policy implications when they take the decisions of changing something because of that as an indicator in recession periods should be taken with more caution. What do you think?
Yes. I have, but actually, when in the banking sector, of course, it's loans, right? More than goodwill and property, plant, and equipment. Right?
And
that gets back. that gets back to Marco's question earlier about financial crises. So maybe we may kind of tying those two things together, and then I'll answer your question, Araceli. It's nice to see you, by the way. Thanks for coming. Is it if the recession, the financial crisis might be a way to, we might find the financial crisis have more to do with banking, more evident in banks than in non-banks. I don't know. We'll see what happens, but you'll see in a minute that one of the things we try to offer in this paper is help to the accountants, because we're accountants, and saying, okay, if this is not if book to market greater than one generally, you can't just use it all the time and just take it as an indicator all the time. How can you do better? And we have one suggestion later on for what to do if you happen to be in. You don't know whether you're in a recession. That's the problem, right? Because NBER tells you later that they see what happens, and then they say, we were in a recession. But when you're looking at trying to make this accounting judgment, for example, right now, you don't know whether we're in a recession or whether one's going to start in 2 weeks or where you sit. The market may start to incorporate some of it, but you don't really know. But the one thing we thought of, which we mentioned in another slide or two, is if you look around to see what is the percentage of firms that seem to have book to market greater than one. Just kind of keep monitoring that. And as that creeps up, then you say, wait a second, there's something that's going on here in the market that is causing this. It's not my asset. It's not that my asset is not recoverable. And I think that's kind of what you're talking about, right? How you might be looking at this and then erroneously think that there's an impairment, because what's really going on is there's an element of macro risk here causing the phenomena. Did I understand you correctly?
Yeah, and maybe taking decisions, standard setter decisions in terms of accounting standard setters, that maybe with an indicator that according to your results, if we can extrapolate to the banking system, for example, what you were saying, they are changing the impairment model to this conservative model, mainly the American model, and according to an indicator that maybe was not saying really that there was so much overstating the assets of the banks. I don't know.
Yeah. I
don't know you want to try with the banking system.
Well, I think between you and Marco, I think I'm thinking that maybe this is something we should actually look at, but it's well, as you know, when you write a paper, you start out one way. This paper has evolved completely from, we assumed when we started this paper that we were going to be doing another, overstated assets, understated liability paper. And then it's like, no, something's wrong, until we went to that conference and heard Ken Singleton and said, wait a second, there's more to this. And that completely changed the way we look at this. So and I'm thinking, putting your two ideas together might be quite interesting to look at. So thank you both. I obviously haven't done it, so I can't answer you right now, but it would be quite interesting, I think, to have a look at that.
Okay, we have another question from Christine. So Christine, if you want to unmute yourself and ask the question.
Yes, thank you very much. First of all, for the interesting results, and couldn't it be a logical next step to explore associations with big bath accounting and incentives connected to those, for example, a weak corporate governance or weak enforcement systems?
As an explanation for book to market greater than one?
As an explanation for a weaker relation in recession years.
Oh, I see. So this is kind of where Marco was trying to go a little bit with, I think, okay. We weren't, yeah, that's a good thought. Okay, we hadn't obviously hadn't thought about it. But I think what you, if I get you right, what we have so far is saying there is this weaker relation in recession years, right? In the second half, right? This 2B is weaker in recession years, and you're asking, why is that? And it may be because incentives change. Right, banks haven't, or not banks, more Arcel, you got me talking about banks now. If the firms have incentives to either not recognize an impairment or recognize more impairment. If they have a big bath, would say, if you're in a recession, things are terrible, write it off. The investors are already expecting you to have a bad year. Everybody's having a bad year. We're in a recession. Now's the time to clean house. That would also weaken this relation, right? But at the end of the day, it's quite interesting. But at the end of the day, it's for a slightly different reason. But book to market greater than one is still a bad indicator, but for a slightly different reason. So I think I've got what you're talking about, and obviously we haven't looked at it, but that may be an interesting thing to do, because you're posing that as an alternative explanation for the macro risk. Yep. Okay. Got it. Thank you.
Okay.
I'm writing all these things down. So.
Okay. I don't think we have more questions, so we can move.
Keep going.
Yeah.
Okay. All right, we know about that. Okay, so we've done some other analyses, and as I prepared the slides, then I realized as I reread the paper, there's even a few more in the paper that we don't talk about here, which is always the case. It sounds like we've got more work to do anyways. So we look to see whether high book to market less than one. We're trying to get a handle on, there's no literal magic at exactly one. I mean, no firm in our sample has book to market equal to one. So we're just using one as the cutoff because it makes economic sense and accounting sense. But, is it 1.505 or 0.95, or when do you cross this line? Who knows? But so one thing we want to make sure is that there is a difference between book to market greater than one and high book to market less than one, right? So you take high book, everything in finance and even in accounting is high book to market, low book to market without a cutoff. We're trying to get a handle for the extent to which our cutoff may actually matter. So we look at high book to market less than one, and we define them as high if they are in the top 70 percentile for the year. So as I showed you, 27% of firms on average have book to market greater than one. So let's say in any year you're in that top 30 percentile, your book to market is in that top 30 percentile. It's just a year in which that's not equal to one. It's not, that doesn't put you over the threshold of one. So it's high for the year, but it's not greater than one. So we redo just about everything else, everything we've done in the paper. Some of it we don't bother because the first result is it doesn't predict returns. So if I repeat the first analysis where I take book to market greater than one, less than one in the deciles, the very first table I showed you, and I split it on high book to market less than one, where there's 70th percentile for the year, it doesn't predict future returns. So right away it's different. And there's no point in looking at, whether HML explains it or risk or mispricing. There's nothing to explain. We also find that the relation with potentially overstated book value of equity for these firms, these observations, is similar to book to market greater than one in non-recession years. So the positive, it is significantly associated with goodwill, other intangible assets. The likelihood of this is associated with those items. But the results are quite different in recession years. Book to market greater than 1 is not associated in recession years, but high book to market less than 1 is. So it's not high book to market less than 1 that they're different. It's different from book to market greater than 1. The second bullet point was the one I was referring to when we were talking to Arcelli. The book to market greater than 1. We repeat our accounting analysis of book to market greater than 1 when there are 33%. It's just 33%. There's no magic here. We probably could do with 30. We're just kind of this roughly 27 to 30% is an average number. Say, okay, what if you look around and more than 33% of the observations, the firms have book to market greater than 1? Well, let's use that as an indicator of a recession year, because as I said, MBR identifies it ex post. That's a year in which using book to market greater than 1 to identify overstated assets or understated liabilities is not so good. That's when things fall apart, and we redo the analysis with those observations and basically find that when we classify firms according to how many book to market above 1 there are in a particular year, we get the same results. So that you don't need to know, you don't need to do the mapping from NBER. Having done what we've done, we now know how to do it. And this can be used as a contemporaneous indicator of a recession year. Another thing we do is we look to see whether book to market greater than 1 reflects exit risk. That is, if we look at it over the next 3 years, are book to market greater than 1 firms more likely to exit the sample? And the answer is no, actually they're less likely to exit the sample. And we break it down between mergers and acquisitions and other types of exit that typically reflect distress to see whether, because there are various types of exit, of course. And we find that for every type of exit that we have, book to market greater than 1 is less likely to exit than book to market less than 1. So it doesn't seem to be exit risk going on. The next item is sensitivity of beta. So this is Petkova and Zhang 2005 is the paper in finance that we found that talks about macro risk as being a phenomenon and links it to high book to market. Not book to market greater than 1, but high book to market. So we follow Petkova and Zhang and estimate the sensitivity of the CAPM beta to expected market premiums. We do it for all years and non-recession years because we only have 8 recession years. So we subtract the all years from the non-recession to see what the implied recession year numbers look like. And we do it for in recession years for firms that switch from book to market below 1 before recession year to book to market greater than 1 in a recession year, and vice versa, from book to market greater than 1 the year before and less than 1 in the recession year. And if book to market greater than 1 reflects macro risk, we expect the beta of below to above 1, so when they went from below 1 to above 1, to be more sensitive to expected market premiums in recession years, and the above to below, the ones that switch the other way around, to be less sensitive. And our findings are consistent with that prediction. So it's a long way of saying they identified a way to estimate whether the firm's systematic risk as measured by beta is more sensitive to market returns for the firms that are greater than 1 in recession years. And the answer is yes. Okay, another thing we did on the mispricing versus risk story is we follow Petrosky 2000. Joe Petrosky, one of my colleagues here at Stanford, has a paper where he creates something called F-score, which is an index of firms' fundamental characteristics, and tries to figure out whether the high book to market firms are mispriced because firms misprice their fundamentals. And he doesn't look at book to market greater than 1 versus other. He also is high versus low. But we test whether book to market firms with high F score, book to market greater than 1 firms with high F score earn larger subsequent returns than book to market greater than 1 firms with low F score. And finding that they do suggests that larger returns arise from mispricing firms' fundamentals. It's the F score that's driving things. Our findings reveal the difference between these two is insignificant, which does not support an inference that the predictable returns associated with book to market greater than 1 come from mispricing. So it's a robustness check, if you will, or an alternative way to think about our risk versus mispricing. One was also in Belinsky, the other is to implement Joe's F score and see whether it looks like firms, there's any evidence, as in his paper, that investors are mispricing firms' fundamentals. And there's a few other things in the paper, but that's about it. Okay, any other questions, Marco?
Not at the moment, no.
Okay. All right, so just to summarize, we find book to market above 1 predicts returns that are associated with macro risk in the sense that they're much greater in recession years than non-recession years. And they reflect potentially overstated equity book values only in non-recession years, not in recession years. We have no evidence that book to market above 1 reflects mispricing. I can't rule it out, but no, based on tests in the prior literature, we can't find it. And there's no evidence that reflects exit risk. Happy to have any other ideas here. And then high book to market below 1 doesn't predict returns and reflects potentially overstated equity book values in recession and non-recession years. So book to market above 1 is different from high book to market below 1. So just to conclude, taken together, our findings reveal that book to market above 1 reflects macro risk, which calls into question using HML as a return factor, prediction factor for BTM book to market above 1, and book to market as a generic measure of conservative accounting or the key indicator of overstated asset book values. And we do offer this percentage of firms in a year with book to market above 1 as a contemporaneous indicator of recession years, and thus an indicator of whether book to market above 1 is likely to be associated with potentially overstated equity book values. And I can't thank you enough for your attention and your great questions and great suggestions. I really appreciate it. It's always nice to present a paper and go home with lots of good ideas on how to make it better. And I really appreciate the opportunity to present today. Thank you.
Thank you, Mary. Again, if there is any last question, we still have a couple of minutes. I have a final one, if I can. Okay, after the summary. So, would you say then that the book to market greater than 1 is not necessarily an indicator overvalued asset every time, or just in recession, during recession?
Just in recession.
Okay, yeah.
Just in recession, because as we have the other results say that in non-recession years,
there is the relationship
it's
between...
significantly associated, and we find this high book to market greater than 1 also is. So looking at a book to market ratio is a good indicator, or well, we don't, it's an indicator, right? Because we didn't take the next step to say, are these assets under impaired? We just say, are they significantly associated with the things that we worry about being under impaired? But that relation is not there in recessions. That's right, and that's why
they may be an indicator of something else. Yeah,
that's correct, and that's why we say. But the next question is, if you're trying to make this a judgment in real time, how do you know it's a recession year?
Yeah,
because sometimes we don't know until it's. And then we can say, just look around, and if the book to market greater than 1 numbers are going up, you're less confident that what you're seeing as a book to market greater than 1 is an indicator of under impaired assets.
Good to know, because this is somehow goes in line with something that, as I said, in the little work that I've done on the relationship between crisis and financial reporting and so on, crisis period are different, okay? And so this is another result that tells that during crisis period we have a little bit to change our frame of mind.
Exactly.
When we look at it, when we look at accounting numbers. And I think this result confirms in a much better way than what I kind of have done so far. But that confirms this idea that what we know from normal years may not necessarily work in recession year. And so we have to be careful in regulating and in policing financial reporting during crisis period, because what is going on can be different from what goes on in standard periods. And I think this result makes it very clear. Yes.
Yeah.
So I don't.
Well, thank you.
Yeah, I don't see any further questions. So I think I interpret everybody's thinking when I say that it was a very, very interesting talk. So thank you very much. We are not surprised. We were expecting it, but thank you very much. You really gave us a very, very interesting thing to think about it, and thank you. And I just want to remind everybody that we will have the next seminar in the first Friday of November, and I don't remember exactly the date. And our speaker will be Sven Model, okay, from University of Manchester. And so I hope to see you all at that time. So thank you, Mary, and thank you all for your presence. And we can close the seminar now. Mary,
Thank you very much.
See you again in the reception after.
Right. Thank you.
Thank you. Bye-bye.